Imagine lending money to a friend, but instead of a handshake, you get a piece of paper promising repayment with interest by a certain date. That essentially is a bond, a contractual agreement to loan funds to someone in return for a promise to repay the loan with interest by a deadline. In the financial world, a business or government can sell or issue bonds to raise funds for various purposes. When someone buys or invests in these bonds, the buyer is loaning funds to the seller, and the seller is obligated to pay interest and then the original loan amount by the maturity date. The primary components of a bond consist of the investor. That's the entity buying the bond. Typically, it will be a government, it can be a corporation, it can be a small business, or an individual. The issuer is the entity borrowing the money. Example, it could be a government, corporation, municipality. The coupon rate, that's the percentage of the principal paid back to the investor as interest. This is typically paid semi-annually, but can be monthly or it can be quarterly. The principal, or the face value, are also called the par value, is the amount of money the issuer agrees to pay the lender at the bond's expiration. The maturity date is the date on which the principal must be paid back to the bondholder. Now, the price of the bond is not to be confused with the principal amount, which is something that I did early on when I started looking at bonds. The price of the bond is the current market value of an existing bond. It can be the same as the face value, or it can be higher, or it can be lower, depending on market conditions. So let's talk a little bit about categories of bonds. Government bonds are issued by national governments, such as U.S. Treasury bonds or SWIFT Confederation bonds. Governments borrow money to finance expenditures, such as military funding or infrastructure development. Both the U.S. bonds and the Swiss bonds are very safe, since it is extremely unlikely that either government will fail to pay the interest and the principal on its debt. Municipal bonds are issued by cities, states, or local governments and offer tax-free interest income. The city of Chicago has issued these types of bonds in the past as an example to finance upgrades to O'Hare Airport. Municipal bonds are relatively safe in that the entity issuing the bonds can simply increase taxes to ensure that the interest and the principal payments are made. Corporate bonds are issued by companies of all sizes for various purposes. Disney Corporation, for example, has issued bonds in the past for theme park expansions and making movies and creating content. They usually offer higher interest rates, but also come with a little more risk than government bonds. High yield bonds are also corporate bonds, and they're formerly called junk bonds. They're a subset of corporate bonds in that these companies that issue these have higher risk profiles and lower credit ratings. They offer quite a bit higher interest rates to attract investors that may have an appetite for higher risk. So let's talk about bond ratings and what they mean. Since some bonds are much riskier than others, we need to know how to gauge that risk. For this, we turn to the ratings agencies like Moody's and Standard & Poor's. Think of bond ratings as financial report cards. A AAA rating is the straight A student, while the D rating might be held back a year. These grades tell you how likely the issuer is to pay you back. A rating of AAA or AA plus is reserved for the safest bonds like U.S. Treasuries. A Standard & Poor's rating of a D is indicative of a company that has a higher probability to default on its debt payments. What are the primary advantages of bonds? The two main characteristics that attract investors to bonds are income and safety. Bonds provide steady income from periodic interest payments, which is a common goal for investors looking for a predictable income, like retirees. This is a depiction of the bond investment model. The investor, or the buyer, purchases the bond at the current market price. In this case, U.S. Treasury bonds. It's a 3-year time frame, and over that time, the investor receives these interest payments. And then at the maturity date, the principal amount is repaid to the bond investor. It's that simple. In addition to income, bonds have other advantages. Bonds tend to be less risky than stocks, especially government bonds like U.S. Treasuries, which are considered to be very, very low risk. That does not mean that they can't decrease in value. It only means that generally they should not drop as much in value as stocks. And if a bond is held to maturity, then the investor receives the original investment back, or the principal amount, which contributes to capital preservation for the investor. In the case of corporate bankruptcy, bondholders have priority over stockholders in that bondholders get their money back first. Bonds contribute to a diversified portfolio to protect against stock market drops, because there are times when bonds perform well while stocks are languishing, or if the market experiences a very large decrease, bonds might not fall as much. Bond prices can go up in value, leading to capital gains if sold before maturity. There are potential tax advantages for municipal bonds because the interest payments are tax-free at the federal level. Other advantages are bond interest rates are typically higher than the rates on savings accounts, CDs, or money market accounts. And there are a multitude of different types of bonds, government, corporate, municipal, with various maturity dates and risk tolerances to satisfy different investment goals. I'd like to draw your attention to this chart. It's a really good example of how stocks and bonds move together. It's only a 6-year time frame, but it gives a good clear indication of how they move together. So the blue line is an index of corporate bonds. The green line is the S&P 500, which is indicative of the stock market as a whole. Now, beginning in 2019, you can see that the green line, which is the S&P 500, took a pretty good drop, while bonds remained relatively steady and going up. Then they started moving up together over time until we got to the COVID year of 2020, when stocks took a massive drop. Bonds took a pretty good hit as well, but not nearly as severe. Then they recovered, both of them. But the stock market recovered in a massive way from 2020 all the way up to 2022, while bonds at some point flattened out. Now, as we move into 2022, the stock market starts taking a significant drop all the way through that year. Bonds do as well. So they're moving together during 2022. And as we move into 2023, stocks begin to recover, but in a volatile way, while bonds move up and then flatten out all the way in, almost all the way to 2024. Since that time, stocks have really been taking off higher, while bonds have as well, but not nearly to the same degree. So the point here is, in general, over time, stocks do appear to perform better than bonds. But when there's periods of volatility, stocks can make a much bigger move to the negative as compared to bonds. Bonds have evolved into one of the cornerstones of investing. They are complex instruments having a variety of benefits and risk. Bonds are the solid oak of the financial world. They're not always flashy, but they are a dependable classic that can anchor any portfolio.